Central banks, are they the glorious redemption of first world capitalism, or are they the demonic influence that's bringing about the demise in our economies? Let's get into it. Hi guys, welcome into Contemporary Issue Wednesday. Today and next week we're going to do a two-part series on central banks. What are central banks? We need to understand what they are before we can either criticize them or praise them. So let's get into it. Alright guys, so what do central banks actually do? Well, simply put, they are in charge of the monetary policy of a specific country and its economy. What is monetary policy, you ask? Well, rhetorical questioner, monetary policy is basically, simply put, the process by which a monetary authority controls the supply of the currency in an economy. And so why do you need monetary policy, or what is the point of monetary policy? Well, there's a few specific things that monetary policy does. The first of which is it targets inflation rate. Now, inflation, simply put, is basically the increase or the steady rise of prices. And on the flip side, it's the steady decline in the purchasing power of your currency. So to give you an example, in the 1930s, 5,000 US dollars would buy you a house and some land pretty much anywhere in the United States. Today, $5,000 would be lucky to get you a used car. That's because of inflation. The other things that monetary policy target are price and currency stability and also employment. So central banks can do a number of things to target these individual goals, but what I want to focus on today is probably what they're most known for, and that is setting the interest rates in economies. And so what I want to focus on here for the rest of the time is how do central banks go about setting the interest rates in the economy, because this is probably the most important thing that central banks are known for, and is probably one of the most criticized and praised aspects of what central banks do. And so central banks can manipulate the interest rates of economies by doing four primary things. And the first one is they can set the limit for reserve requirements of banks. What does this mean? Well, basically every bank that you go to and you deposit money in, at least in the United States, but it's probably similar everywhere else, there is a requirement set by the central bank. In this case, let's take the United States. There's a requirement set by the Federal Reserve about how much money these banks have to store in cash in the Federal Reserve. And if the Federal Reserve, if the central bank wants to increase or wants to grow the economy, they can lower the requirement of how much money these commercial banks need to have in the Federal Reserve. So the Federal Reserve says we need to stimulate the economy. They come to the commercial banks and say, hey, look, we're going to lower the requirement, the cash requirement you need to put into our Federal Reserve, into our centralized bank, so that you have more money available to lend out to different people for different reasons. If central banks want to slow down the economy, if they want to slow down inflation, they can say, okay, we're going to raise the reserve requirement that you guys have to have in our central bank. And so we're going to require you to put more money into the Federal Reserve, giving you less money to lend out to sort of pump the brakes on the economy. That's the first way central banks can set interest rates. The second way central banks can control the interest rates is they can actually set the interest rates that commercial banks borrow money from the Federal Reserve or the central banks. And so the point behind this is if the Federal Reserve wants to stimulate the economy, they can lower the interest rate, the borrowing rate that commercial banks borrow from the Federal Reserve, in the hopes that these commercial banks, when they're lending out money, will lower their interest rates when you come to them and you want a mortgage or you want a car loan. So that's the second way central banks want to go about manipulating the interest rates. The third way central banks can manipulate the interest rates is they can buy up government bonds. And this does two things. The first thing is when the Federal Reserve buys up a bunch of government bonds from the U.S. Treasury Department, what it's doing is it's infusing a bunch of capital into the marketplace, which infuses more liquidity into the markets to make transactions and credit and borrowing easier. Now, the second way buying government bonds can manipulate the interest rate is buying up government bonds means that you're buying up government debt. You can basically fund the debt of your country. And so if your government wants to go on a fiscal spending spree, it wants to institute infrastructure spending or defense spending to stimulate the economy maybe, then the Federal Reserve or the central bank can buy up that government bond in order to finance the government debt. The fourth and final way central banks can manipulate interest rates is by engaging in a behavior called quantitative easing, or QE. So QE is something many of you have probably heard about since the 2008 financial crisis, because it's kind of a new pioneering technique used by central banks and monetary policy authorities. Basically what QE is, in addition to the first three resources I already mentioned about how you can manipulate interest rates, QE also adds a fourth dimension, and that is that central banks can actually buy into long-term assets onto the stock market. So a great example of this was after the 2008 financial crisis. One of the things that the Federal Reserve did in the United States is it started buying up a lot of these bad mortgage loans that were lent out that were sort of infecting the financial system. And so this is a really sort of unique, cutting edge, very controversial policy that central banks can institute, because it means that they're getting involved deeply into private sector assets like mortgage loans. And originally, central banks, if they were going to get involved in the stock markets, would basically limit themselves to buying up government bonds. Taking the extra step of starting to buy into longer term assets in the stock market and private businesses and private companies is very, very controversial. A lot of people think that the government should not be in the business of doing this type of thing because it's government overreach. It's much too centralized planning. It doesn't let the market sort of play itself out. So on the one hand, economists and many people argue that QE is a valuable resource that central banks have been able to utilize, particularly since the 2008 financial crisis, that they needed this kind of tool to be able to stop the financial apocalypse that was the 2008 financial crisis from becoming even worse, while people on the other side say, no, this is way too much power that's vested into central banks. So the last 2 points I want to make today are this. Firstly, why is manipulating interest rates so powerful? Well, interest rates are really powerful because if you increase interest rates, then it decreases the incentive for people to go out and spend and to borrow, right? Because if the interest rate is higher, you're going to be more reticent to want to borrow. If the interest rate on a loan is 1%, you're probably real likely to go out and borrow to get that loan. If the interest rate is 12%, it's going to make you much more hesitant before you go out and you want to pay 12% interest on a loan. So increasing or decreasing the interest rate has a direct correlation into how much people want to spend and how much people want to save. And so it's a really important, powerful tool in the arsenal of central banks to regulate the economy, to engage in monetary policy. And the second and final topic I want to discuss today, and this kind of alludes to next week when we get into the more controversial issues surrounding central banks, is that central banks by and large are usually run by unelected, appointed government officials. And a lot of people have trouble with this because central banks, as you can probably tell from this video, are extremely powerful institutions. I mean, they control the currency. That is an extremely, extremely powerful institution because we all know how powerful money is, how powerful economic interests are. So a big worry is that governments and society have placed an inordinate amount of power in people who are unelected, who are unaccountable directly to the electorate, that people are instituting some of the most important policies, economic policies that a country can have instituted, and it's put in place by people who are not accountable to the electorate. Now, people on the flip side say it is so important that the people who run central banks aren't elected, aren't accountable directly to the electorate, because they need to be detached, they need to be as objective as they possibly can. That economics, economic theory, monetary policy is an extremely technocratic, extremely specific, sophisticated art, and to make appointments on the basis of people who aren't actually very knowledgeable about economics would be disastrous for central bank policies, because you would put people in the highest branches of power who are tethered to special interest groups. And so what we want is an objective, detached, technocratic central bank who can make the best decisions possible, and not for a specific interest group, but for the economy as a whole. So that's the two kind of competing sides of the coin. One, people say there's way too much power vested in people who aren't even elected. The other people say it needs to be like that so that these people who have so much power aren't pulled by special interest groups, that they can do the right thing without having to worry about the voters' angst. All right, guys, so that's it for today. Next week, we're going to get into some more controversies surrounding monetary policy and fiscal policy and things of this nature. But what do you guys think about central banks? What do you think particularly about central banks officials not being elected, but being appointed and not accountable directly to the electorate? What do you think about that? Comment below, let me know, share the video, subscribe to the channel, and remember, reality always trumps ideology.